Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. It's that time of week again where my business partner, Sam Rust, takes over the show and interviews our guests. I hope you enjoy the show. This is your daily real estate syndication show. I'm your host, Sam Rust. With me today is Blake Janover. Blake is the founder and CEO of Janover Ventures, a fintech company connecting multifamily borrowers with lenders and processing upwards of $2 billion per month in loan requests. Blake has been published in Forbes, Housing Wire, many other publications, and is also an official member of the 2021 Forbes Real Estate Council. Blake, welcome to the show. Thanks for joining us today.
Thanks for having me. I really appreciate it. I said it before, but I say it again now publicly. I really appreciate it very much.
Certainly. So I was snooping a little bit through your LinkedIn profile, Blake, and you've got a long background in finance. I wonder if maybe you could just sketch for our audience, how you got started in real estate finance and what your career path looked like before you started Janover Ventures a couple of years back.
Sure. I'll try not to bore anybody, but my entry into real estate finance was early in the last cycle. If you see me looking up here, it's like sometimes I collect data from somewhere up there. This is going to be audio too. So for people that aren't that are listening, I just like gaze up and to the left. You may want to
wherever you get inspiration, Blake.
You may want to edit out this whole thing. So I started in real estate finance in the very early 2000s. It was my first serious career. I actually started in quantitative finance, doing rating trading algorithms for public market equities, and one thing led to another, and the market was kind of hot. I ended up in real estate finance, and in my late teens, very early 20s, I became a residential and commercial mortgage broker, and then a mortgage brokerage business, and then a correspondent lender, and then a lender with warehouse lines. And I closed my first big, 20 some odd $1 million multi-tiered capital stack deal, maybe around like 22 years old, maybe 21. I don't know. I've actually got the article behind me over here. My mom framed it for me. She was so proud of me. So I started then, and I've been in the business in one capacity or another for the last decade and a half. I did do other things that involved debt markets in general and technology in general, but I always kind of came back home to multifamily and commercial property finance, and kind of where technology touches it.
Appreciate the sketch. So on your website, janover.ventures, you've got this phrase. It says you advocate for small and middle market multifamily property investors with technology charged financing. There's a lot going on there. But I wanted to unpack that a little bit because many of the folks that listen to this show are beginning in their syndication journey. They want to get that coveted agency card, and most that's the main option that people are aware of. But what does it mean when you talk about technology charged financing? What's wrapped into that phrase? Because that's a very intentional choice of words.
Sure. So one of the premises or the initial intent behind Janover Ventures was to remove frictions in the commercial property financing process. So as you already know, I've been in the business for a decade and a half, and I've advised on or underwritten or closed gazillions of dollars in loans. That's not an actual number. We'll just, but some very significant number of transactions. And I'm keenly aware of all the pains, right? You put together the property financials, your financials, you call the lender, you give them the information, they ask you some questions, they send it to the underwriter asks you the same questions, they request the same documents they already have, the appraiser comes in, he asks you for the same documents, you have to make sure the documents are matched up, everything's being done kind of like it's 1995, right? It's still happening in Excel, it's wild. And you're talking about tons of touch points and just to kind of get down the road with one lender, where you may get a term sheet, sign it, and then find out 3 weeks later that actually you're not going to get that kind of deal at all. So what we've done is we've taken very intentional steps of removing frictions in the process. So the initial friction of getting a loan package together, right? Through our portal, somebody can answer questions and kind of interact with a digital loan processor who's asking all the questions that mortgage bankers want to tell you are intuitive and intuition and based on 15 years or 20 years of experience. And it's nonsense. Everything is if this, then that, right? So we dive deep into those questions, and then we're dynamically building a deal package while somebody's going through our secure portal. And what I have been able to do with all my years of experience is get the right lenders into our portal also. So it kind of acts like a Tinder or a matchmaking. So as this deal package is built, we know based on all the data points given plus data that we're grabbing, who's the right lender for the deal. And we're able to get it in front of that lender and to create the direct connection and the interaction right through our portal. So that's the technology charging it, right? And then as far as opening it up to small and middle market borrowers, first off, middle market can be up to $50 million loans or $25 million loans, right? And small could be $5 million loans. But for the purpose of this conversation, we could say small is anything from $1 million to $5 million, and middle market is from $5 million to $25 million. New and small borrowers, people doing their first deal for $2 million, shouldn't feel bad. I don't know if they do, but I wanted to say, don't feel bad that your only relationship is a broker or a bank that you've done business with, or you're not sure what all your options are. We've done deals for public housing authorities. We've done $20+ million loans for really sophisticated investors and really sophisticated borrowers and syndicators who just didn't know what the other options were, or knew that the option that they were offered just didn't feel right and wanted to see what else is out there. So that's kind of where we are, right? Like working with that universe and using technology to make it less painful and make better connections for better connections for borrowers and for lenders, because lenders don't want deals that don't work for them, and they don't want to send you a term sheet and change it later. They want the right deal. Borrowers want the right deal. And so we're working on a better mousetrap.
Yeah. Oh, that makes sense. So there's a ton of options. There's a kaleidoscope of options when you're going to look at financing a property. And maybe focusing on somebody who's starting out. Maybe it's a small apartment complex. They're getting a $5 to $7 million loan, something along those lines. What are maybe a top option or two that you see frequently gets ignored, overlooked, or just frankly doesn't have that much publicity around it?
That's I'm just going to choose one, and it's FHA. Now, as I say that, because you're talking about a purchase, HUD's not always the best option for a purchase because it takes a long time to close, and it might be a better option for a refinance, but it's a very overlooked product. So a lot of people associate HUD with affordable or Section 8 or things like that. But the reality is HUD insured financing is available for market rate properties all over the country, and LTV, loan to value ratios, are up to 85%. I think the last deal we quoted was in the 2s. It's non-recourse. It's fixed and fully amortizing for 35 years. And by the way, for first-time borrowers and small borrowers, I can't stress enough how important non-recourse is. If you haven't been around for a cycle like I have, and others like me, it doesn't make me better, by the way, right? Like I got drowned in the last cycle. But if you haven't been around for a cycle, you haven't really experienced firsthand what happens when markets capitulate. During COVID-19, Fannie Mae and Freddie Mac kept a steady flow of liquidity into multifamily, and cap rates didn't explode, right? They remained tight as interest rates kind of plummeted and stayed really low. So things go wrong, and non-recourse is really important. So FHA would be like my favorite overlooked product. And I think you'd be surprised, but a lot of first-time borrowers don't know that they can get Fannie Mae agency financing. I think there's an impression that You can't do that as a first-time borrower, but you absolutely 100% can. If you hit the net worth and liquidity requirements, you're close to the property within 100 miles, you're using a third-party property manager, you can buy an apartment building and get a loan for as little as $1 million from Fannie Mae, a 30-year fixed and fully amortizing loan. That's non-recourse if you wish. So I get a little excited, and I apologize for that. You can hear
no, that's fantastic. I love the stressing on non-recourse. I mean, on our side, we've signed on some limited recourse, but have a preference for non-recourse wherever possible. It really depends on what our plan is for a specific complex, whether it's a quick flip and we're trying to eliminate prepay penalties or other things. But it is interesting talking to some of the guys who've been in the industry 20, 30 years. They continually come back to the importance of that non-recourse debt. I think everybody who lived through 2008 knows exactly why.
Yeah. And, it's not to say that there's not a place for limited recourse or for full recourse. It's just to say, don't take it lightly. Like, I know that you don't, but speaking to other folks that are newer into it, like, I'm just going to take an 85% 20-year amortizing floating rate bank loan. Well, you're better off to raise a little more equity and take a little risk off the table and run a better debt service coverage ratio. I wouldn't advise any first-time borrowers to go do deep value add deals that require structural rehabilitation. You leave that to the SAMs and so everything's always, of course, very deal dependent, but like as an overarching theme, avoid recourse where possible.
Yep. Makes sense. On the FHA program, one of the specific programs that I've looked into is the 223F program, I believe it is, through HUD. They've recently relaxed some of the guidelines around how long new construction has to season before they'll put that type of loan product on it. Generally speaking, though, with an FHA loan, whether it's 223F or some other program, you mentioned it takes a little bit longer to get through the loan process on an acquisition side. What should people generally budget from a timeline perspective, from when they start the process to when they can safely expect to be able to close a loan? I'm guessing, based on what I've heard, it's more than 60 days.
Yeah, so it is. For anybody listening, I have a big smile and I'm quasi laughing because how can you safely estimate how long it takes the U.S. government to underwrite something? But if you have a highly competent lender, the conservative number, if you have to be including extensions and everything else, you might have to leave yourself 9 months. I mean, they can close in 5 or 6 months. Or less, not likely. I've found historically that 7 months is a safe window. And this is nothing compared to a 221D4, which is, in my opinion, the ultimate construction financing product if you're not merchant building, right? It's 45 years or 40 years fixed and fully amortizing, plus up to 3 years interest only fixed, non-recourse, 85% LTC. It's like the best of the best, but we've had D4s take as much as 24 months to close. I'm not saying that that's how they all are. We've had, streamlined ones that have gone in 10 months or maybe less, but man, nothing is smooth or easy. Although the FHA has made real efforts to improve the process. They really have. And some lenders have done an excellent job in streamlining. So there's hope out there.
Yeah, hopefully as technology continues to creep into a good old boy network, so to speak, we can continue to eliminate a lot of the friction like you guys are trying to do at Janover Ventures. When you're working with newer borrowers, do you have any tips or mistakes that you see pretty frequently that you would caution people against when they're prepping their loan packages or working with a company like Janover?
On a purchase, the most common thing I see is not estimating the right real estate taxes, right? Like you get I won't say Marcus and Millichap or Cushman Wakefield, but you get an OM from some company, and it shows your pro forma, 6 cap or 7 cap, and The real estate tax number is the same when you're buying a $5 million property from a little old lady that bought it for $90,000 100 years ago, right? Like your real estate tax bill is going to go up in some cases really significantly. And that's a material factor that I think people forget to contemplate in their underwriting. A common mistake I also see for first timers. I don't even remember if you asked about first timers, but I'm
first time. Yeah, that works.
A common one I see for first timers is I live in LA or Austin. Properties are 2.5 caps out here, so I'm gonna go to St. Louis and get a 15 cap. I found a deal on LoopNet. I'm so smart. And, if my mother would say to me, like, why are you so lucky? Right. So usually, I don't want to criticize. I'm criticizing. I'm not criticizing LoopNet. I'm not criticizing Cushman Wakefield. I'm just saying that if you find a 15 cap and you have to collect rent in a Teflon vest, like you have to, there's a lot of things to consider besides just what's the cap rate. Geography really matters. Property management really matters. Somebody that manages single family has no business managing multifamily. Somebody that manages Class A institutional multifamily has no business managing, a C plus, transit deal in a market that's gentrifying going. So these are all things to really take seriously ahead of planning the package. When it comes to a package, hit your net worth, hit your liquidity, give a detailed T12, a trailing 12-month, month-by-month P&L, back out CapEx from your operating expenses. It's not an operating expense and it shouldn't be underwritten as one. Have a detailed rent roll. And in the era of COVID, economic occupancy is more important than physical occupancy.
Yeah, I think economic occupancy was often overlooked, and it was just, well, what do you have on your rent roll? And then that fallacy was exposed certainly over the last 18 months. We certainly saw that at our properties as well. I mean, everybody was struggling. It just was kind of to what degree. I think overall, if most property owners did better than maybe they expected, if we go back 12 months, 18 months, it certainly was an interesting spring of 2020.
No kidding. But I have seen the deal or two where it's like 100% occupancy, but like we're not really collecting any rent, and that's not really a financeable opportunity.
It's not terribly meaningful to investors, bankers, anybody.
Right. Well, I'm so glad there's people in your building, but we're gonna need cash flow.
Definitely.
If you're interested in multifamily real estate but don't know how or where to begin, our guide on how to start investing in multifamily real estate breaks down everything you need to know about identifying good investments plus real-world examples. Download your copy in the show notes or visit lifebridgecapital.com/start now to start your journey in multifamily real estate.
So I'm curious, Blake, going back to your LinkedIn profile, I noticed that you are an entrepreneur in residence at Florida Atlantic University. I was just curious if you could elaborate on what that is and what you contribute to that university.
I'm homeless and I live in their cafeteria. So it's something entrepreneur.
I hear cafeterias are a great place for food. So
no, it's a fancy way of how they say that I'm in their mentor program. So students have at FAU, and it's a really cool school, and much bigger than I knew, and really beautiful. It's crazy because I lived in Boca, where I live now, Boca Raton in the past, and I live here now again, and I just recently visited the campus, or not so long ago, and was blown away by how beautiful it was. But like I judged a startup pitch event recently, and student entrepreneurs that are looking for feedback or help with their startup or with their ideas or whatever, they can reach out to me, and I'm really excited to hang out with them and iterate or explore or ideate, if that's a word. So
what do you mean when you say ideate? Could you expound on that a little bit?
Well, I pulled it from ideation, which I'm not sure if that's a word either, but it would, I suppose it would be the verb of idea. It would be the process of coming up with and exploring ideas. You'll have to let me know if I'm just completely making words up on your show.
Well, I think you just did, but I like it. So we'll allow it. All right.
Thank you. You're welcome. By the way, you're welcome to edit any. You might choose to edit out 50% of this conversation, and I would hold nothing against you for it.
No, this is fantastic. So this process, to use your phrase, ideate, or your word, ideate, I think it requires innate curiosity. And we were talking about this before we started recording, but reading certainly is an important part of exposing yourself to a wide variety of sources. What piques your curiosity, and how do you satisfy it other than just reading a tremendous amount of material?
What piques my curiosity and how do I satisfy it? Well, besides reading, reading is probably the biggest thing. When I find a subject matter or a person or an idea that I want to know more about, I deep dive until I get bored with it. So I consume a very eclectic the amount of data I consume and information I consume it's super eclectic. So I could be at the reading, and it's not that I'm particularly smart, right? Like I have to read all these things because I'm not so smart, and I there's like so much for me to get, and there's so much that I don't know. But I could be reading about like physics and mathematics and science fiction and Richard Feynman and Jamie Dimon. I can have and public equity analysis, and I can have like 10 of these books open at the same time. Not like at once, like changing pages, like looking at all of them at once, but like, something in the bedroom, something downstairs, an audiobook, and I'll deep dive on podcasts on certain subjects that I find interesting. You and me were talking about it. We both got probably more curious about crypto over the last 12 to 24 months. So I've done all kinds of exploring around there, and I like to fiddle with things. So like I like to download the apps and touch every button and like look in every nook and cranny, and I'm a nerd, so or a dork. I'm not sure what the right word is, but that's it.
So you mentioned crypto, and I did want to touch on that briefly. For a lot of folks, maybe members of our audience, they're just now being exposed. Bitcoin is certainly in our cultural zeitgeist, but now maybe people are starting to hear decentralized finance. And I know neither of us pretend to be experts. I think there's very few actually qualified experts in the field because it is so nascent and it's changing so quickly. But do you see any crossover between crypto and real estate, either now, in the near future, the midterm? What's your outlook for how those two asset classes, if we can call crypto an asset class, and how they will potentially intersect and interact with each other in the future?
I love this question, and I think it's appropriate to say that I have neither laser eyes nor diamond hands. I don't think I own any Bitcoin. I haven't been part of the boom or subsequent dip or anything else. But I'm like, and I'm not sophisticated around this at all, right? Like there's some really smart guys. I'm not one of them, but I do really like and I've explored a lot the idea of not so much where crypto, I think crypto gets too much hype over the foundation of blockchain, right? Like this foundation of like transparent kind of publicly shared transactions that are super secure. And the problem with crypto, or maybe not the problem, but a challenge with crypto, if you wanted to like tokenize real estate, is that it's not materially different than selling units in an LLC. It still comes under the same scrutiny of the SEC and regulators. But what's really interesting is if you could put entire transactions and all of real estate on the blockchain, and you would have to develop kind of like some kind of Oracle network that can okay, I'm excited, but like, what if you could just do the whole transaction on the blockchain? So I'm buying the property as a GP, raising capital, maybe tokenizing it. For me, this is immaterial, but now the property, the title to the property lives on the blockchain, and now you can, when it changes hands, it can change hands on the blockchain. And when a borrower makes mortgage payments, or even better, when a tenant makes payments, like, it all happens in that ecosystem, then everything can become really transparent, and distributions can be fully automated with smart contracts. And man, there could be like it's really limitless what can happen once you include municipalities, and tenants and payments. You could have streaming payments, right? Where tenants are paying by the moment, and distributions are happening by the moment in real time, and property taxes and insurance are coming out by the moment. Everything becomes much more fluid and transparent. But it's a Herculean effort to get title companies. You talked about good old boys. Talk about like the ultimate good old boys, right? Like, this whole title insurance process is ridiculous. I think States Title is trying to innovate there, but you got to get title companies, municipalities, GPs, LPs. A lot of people have to come on, but man, that would be really cool.
Yeah, as I've thought about that question myself and tried to figure out what does the future look like, if you take the most optimistic view, it's pretty amazing the synergies that could be achieved, and the intermediaries that you could do away with, and really eliminate. We're back to friction again, but using that technology of the blockchain to eliminate so much of the friction that exists in real estate. But there's so many institutional players that have been part of the landscape for hundreds of years that aren't going to go quietly into that good night. And are slower to adopt technology. And so I'm really curious to see over the next 5 years what happens, particularly around title custody. Can we ever get title onto a blockchain? I think the answer is yes.
Yes.
But you have to achieve a certain level of scale to make that feasible. And I've just struggled, maybe El Salvador is going to be the first country that starts going in that direction. They've adopted Bitcoin. Maybe they'll start the real estate trend as well. But I think it's going to take something like that, maybe even a state that's willing to go through that Herculean effort to get everything up onto the blockchain. Because once it's there, it's so much easier. It's porting everything over, whether it's through oracles or some other form of network, that's going to be the challenge.
I think when a small group of people in like an innovative market, like, you could say, I don't want to say San Francisco, so whatever, like maybe Miami says, all right, look, we're moving everything, like we're moving everything around title and deeds, like this is all going on the blockchain. And I think when it happens in a small place, then it spreads. And I think that there's a really interesting case for making everything more efficient. Right now, there's a lot of people that are like crazy about DeFi, right? And right now it's a bit of a mess. Like, transactions are really expensive. There are very few actual decentralized platforms. Most platforms are fully centralized. Even the decentralized governance guys are only like decentralizing part of their governance, but like not all of the governance. And so there's kind of like a lot of bad actors to work through. There's a long ways to go, but I don't have any doubt that if the technology is has all the latent potential that it seems to have, that there'll be a change of guard. There has been in every massive innovation, from flash drives to tablets to smartphones. It happens, and Kodak, right? The film. So it'll happen. It's just who's gonna get in on it first? Who's gonna be like the early innovators? Who's gonna take the risk? I hope we're a part of it, but we'll see.
Yeah. I've heard decentralized finance specifically referred to as the Wild West, where the land has just been opened for settlement. We're pretty sure that all the land has value, but we don't know where the cities are going to be. And so we're trying to figure out, where's the oil? Where are the good mines? Where are the cities going to be? And you hope you don't end up with the desert wasteland when you stake your claim. So there's definitely a huge component of buyer beware. But there's tremendous value being created also. And so sifting through that noise requires a lot of research, requires diamond hands a little bit to a degree. I mean, you have to be convicted on your thesis and then follow it through because of the extreme volatility. You definitely can't look at your portfolio on a daily basis unless you're taking something that helps your mood stay at equilibrium.
Yeah, listen, it's a very there's a lot of speculation. There's a lot of things that aren't valuable that are moving as if they are. We're in like cohorts of all asset classes are like wildly speculative. There's I don't want to upset anybody and mention Dogecoin or Shibuya or whatever these other things are. But I mean, there was an invisible sculpture that sold recently. I don't know if you saw that. Somebody sold an invisible sculpture for a crazy amount of money. And I'm not, I could offend somebody with NFTs. NFTs have a use case, an excellent use case, like perhaps music royalties and things like that. But, there's other cases where it's hard to get my arms around. And I'm sure somebody smarter than me will send me a shitty email or text message. Sorry for cursing. But the underlying infrastructure, like this distributed ledger thing, is really cool, and I think it has a place in the future of financial markets.
Yeah, I completely agree. Pivoting a little bit, Blake, debt has been highly volatile over the last 18 months or so. As you, from your seat, look out over the next 12 to 18 months, and I like to ask folks, what do you think is going to happen in the real estate market? But I'll ask you a little bit more pointed. What's going to happen in the debt market from a broad standpoint? And what leading indicators should people be paying attention to that will signal, hey, a change may be afoot as far as interest rates and liquidity in the marketplace?
That's a good question. It's easier to speculate on where real estate's going to go, where broad markets are going to go. But if you ask me where real estate debt markets are going to go over the next 12 to 18 months or so, it's hard to say. So one of the leading indicators is going to be inflation. If you believe that inflation isn't transient, or that inflation is going to continue to grow, you should have the expectation of higher interest rates in the future. If the Fed comes out and indicates tomorrow, which is Wednesday, so that's not really going to be evergreen, but if the Fed says that they're still going to remain very accommodative, and you believe there's going to be inflation, then you really have to worry about interest rate spikes. If the Fed say they're going to raise interest rates, then you have to worry about longer term interest rates. And so it's really going to be very tied to inflation, right? From an asset class perspective, multifamily and of course industrial, like last mile delivery, this stuff is still super valuable. So maybe the second order consequences worth contemplating are if interest rates stay the same and there's no inflation, like everything's going to be okay. There's going to continue to be a lot of liquidity from Fannie, from Freddie, from the FHA, from banks, from credit unions. I wouldn't expect any really significant shifts. But if rates do move up, one of the things to contemplate is what that does to cap rates. And those second order consequences of property value, especially if you've got some kind of pro forma exit or a pro forma recapitalization, right? Like we want to refinance in 3 years, but if interest rates are much higher, cap rates are going to be much higher. What's my property going to be worth? So it's probably worth running stress tests once you start looking out 12 to 24 months in the future.
So it sounds to me like you're making a bullish case on fixed rate debt. Is that a good way to sum it up? Because you didn't outline a scenario where interest rates drop. I was listening for it. I didn't hear it, Blake.
So yes, but I've had this silly bullish case on long-term debt for like 10 years. And 10 years ago it was in the 5s. And I thought, I think if you're getting a loan in the 2s or the 3s or the 4s, take it as long-term as you can. Get a 30-year amortizing loan if you can. But I thought that, several years ago when rates were in the 5s and a few years ago when rates were in the 4s, and we've closed deals in the 2s recently. So I'd caution you about taking my advice. I apparently am really bad at predicting interest rate markets and inflation.
I think 98% of people in the financial realm fall into that. I know that one of our first loans, we locked at a 4 flat, and I just was dancing for days after that. And then we locked a loan at like a 2.8 here about 6 months ago.
4 is still worth dancing. It's like you live a beautiful life, right? You've got like a nice house, a nice car, good kids, and you go on Instagram and someone's got a better house and a better car and better kids. You're like, your 4% is really good. Get off I can't say get off Instagram because it's good that you got a 2.5% loan later, but 4 is good, 2.5 is good, 3 is good. These are great rates. When you look at it from a macro perspective over the last 50 years, 100 years, you're doing amazing. So yeah, lock in that long-term fixed rate financing. Be real careful about that floating rate debt and those loans that recast in 5 years for sure.
Yep. Awesome. Well, as we close out here, Blake, really appreciate you joining us today. Where can our audience learn more about what you're doing at Janover Ventures, and how can they connect with you?
So you could just go to janover.ventures. It's not .com or .net or .edu. It's janover.ventures. And you can see kind of what we have going on. You can apply for financing. You can invest. We're raising money. It's all right there. And you can find me on LinkedIn if you just look up Blake Janover, on Twitter, where I get a little weird, as you can imagine. It's more professional on LinkedIn. And I hope to see some people there.
Fantastic. Well, thank you for joining us on another episode of the Real Estate Syndication Show. Have a great rest of your day.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.